Good afternoon, folks. Happy Thursday, and welcome to this week's commentary. I'd also like to wish everybody a very happy 4th of July weekend as we celebrate the 250th anniversary of this great country, the United States of America. For the holiday, the markets will be closed tomorrow, and so too will our office. That is Friday. So certainly much has changed since the bicentennial 50 years ago, and most of it, I believe, has been for the better. Certainly that's been the case for the stock market. Indexes have greatly benefited since our last milestone birthday celebration 50 years ago. Now, the fourth on that year fell on a Sunday, so the business day Friday, July 2nd, 1976, closing for the S&P 500 was 104.11, while the Dow closed at 999.84. Today, these indexes sit at roughly 7,500 and 52,600 respectively, while annual returns with reinvested dividends for both indexes were roughly 11.5% per year. Folks, that's a strong argument for staying the course in the markets through thick and thin. I understand that we don't all have 50 years to sit back and wait for such great returns, especially for those using their nest eggs for retirement purposes. But with good management, proper liquidity, and safeguards, regardless of where you are in life and what your needs may be, accessing similar returns can be available to you. Looking at the longer term going forward, unless our current capitalist system, which has generated more financial well-being and a higher standard of living for more people than any other system in history, collapses, it is reasonable to believe that those celebrating our tricentennial and then reflecting on the previous 50 years dating back to today will be celebrating similar, if not better, results. And I say possibly better because of the potential significant efficiencies AI is likely going to bring to corporate bottom lines. However, unless some things societally begin to change, starting, in my humble opinion, with what students are being taught in higher education for a generation, that standard of living and way of life could be in jeopardy over the long term. When, over the past 25 years, one party has seen its patriotism, that is, a number of people who say they love their country and its way of life, drop from 85% to 26%, and is currently electing socialists proudly intent on tearing down the current system, alarm bells should be ringing across the land. While this is not a political commentary, should the current trend of socialism grow and reach national dominance, that could pose an existential threat to free markets and our current way of life. Good news is there are many ifs for that dire long-term outcome to become a reality. And regardless of what may happen this November, that potential threat would be years away. And as such, I will neither have ongoing commentary on this phenomenon, at least not in this forum, nor will I be reacting from an investment standpoint in the short term. Because short term, regardless of who is elected in November, likely very little can be changed over the next 2.5 years. And whenever there is overreach from either party in power, we typically see the pendulum swing in the opposite direction at the next election. We've seen this phenomenon play out since the founding of this republic, and I think it will continue. It has been particularly notable over the past 20 years or so. So this pendulum looks like it may swing again in November. We'll see. But if it does, it may well swing back again in 2028. But, given that we are celebrating this country's 250th anniversary as a free and independent country, it is timely to reflect on that past and consider the future. In the meantime, reflecting on the first 6 months of the year, we can find much to be grateful for in the markets. Now, as a result of the nearly 16% second quarter gain for the S&P 500, its best quarterly result since Q2 2020, the index is now up 9.5% for the year. During the first half of the year, to get there, markets have climbed a wall of worry that include tariffs, higher than expected inflation, an inflation rate narrative that has changed expectations from multiple rate cuts to rate hikes, a war in Iran that is not yet over, a significant spike in energy costs, and ongoing and growing concerns regarding the payoff of hundreds of billions of dollars of CapEx spending. However, despite all this, the economy continues to grow and earnings continue to surprise to the upside. For Q1 2026, 85% of S&P 500 companies beat expectations, which is well above normal. At the same time, earnings estimates have increased to 23% growth year over year. The result being that the market is cheaper today than it was when it entered the year. Earnings growing faster than share prices. So as long as the economy remains afloat, there is little reason to believe that a significant sustained sell-off lies ahead. Now, I do emphasize sustained, as there may be seasonal weakness that could accelerate to the downside in the near term. This year's been volatile. Over 25% of trading days this year have seen the S&P 500 move more than 1% in a single day. With that type of volatility, short-term jitters could lead to uncomfortable levels of selling. But even if that were to occur, it would be happening against a backdrop of sound and improving fundamentals, meaning any correction is likely to be short-lived. And trying to time corrections versus bear markets is always, most of the time, always, I think for most people, a losing strategy. So rather than focus on short-term swings in the markets, it is much more productive to focus on long-term fundamentals. And on that basis, we look solid. We will, as always, closely monitor those fundamentals and inform and react if necessary accordingly. In the meantime, have a safe, fun, and celebratory weekend.